Let's now turn to the advisory, particularly with a view on small business owners and retirees facing financial risk from emergencies, illiquid assets and rush legislation. So what kind of strategies can safeguard wealth and ensure long-term stability? Well, Liam Shorte is a regular on the show, joins us now again from SONAS Wealth. Liam, good to catch up with you. So is this a particular problem then that perhaps some small business owners leave themselves in a sticky situation because they simply don't have enough savings to draw on when they get into trouble?
Well, it's just the nature of the economy at the moment, Andrew. Staffing costs have gone up. Materials and input of goods, everything, the cost of everything has gone up. So a lot of businesses are finding their profit margins are squeezed, and so their cash flow is squeezed. So we're finding things like in small business owners not paying their own super. Just trying to cut back stuff. So they really need to try and stay on top of things. So we look at opportunities to say, look, how can we set your business up for the future so you don't face these short-term cash flow problems. One of the things we do with a lot of small business owners is to try and get their business property into their super fund, through a self-managed super fund. And that's, the benefit of that is, one, it's inside the superannuation system and it can be protected from bankruptcy if something goes really wrong. And there is time limits on that. But two, you got some certainty of tenure. You're your own landlord and your business then is paying rent to your actual super fund. So the beauty of it is that you can then release that capital in your actual business, in your business entity, to actually grow your business or sustain your current business, and your super fund is carrying the capital value of the property. So we look for ideas like that, and one of the other ones we're looking at is as a person reaches age 60, there's the ability, even if they're still working in their business, to use the transition to retirement pension, and that can give them access up to 10% of their balance in their super each year to help with that cash flow. So in some cases, we're really telling people, don't stop paying yourself super because it's low. The super guarantee law is there. But if you're over 60, what you can do is take some tax-free pension out and use that to fund the business contributions into super for you. So don't just think there isn't a solution. Talk to your advisor, talk to your accountant, and look for ways to try and solve that problem.
All right, so you see a part of the solution there, potentially moving to an SMSF. Just in terms of that, having an SMSF, if you perhaps lose your mental capacity, how do you deal with that? I gather that is a fear of many members or self-funded retirees. How can you account for that?
Yeah, so, and it's not just SMSFs, you find it often in a couple, there'll be one person who deals with all the finances or pays all the bills. And the problem is nowadays, every person needs to be able to do banking. Every person needs to be able to deal with their legal issues and basically able to pay the bills through BPay or whatever facilities available to them. And you can't just leave it up to one person, because with two-factor authentication and all these new security levels coming in, it's harder for someone to pick it up later. If their partner gets mentally incapacitated and can't do stuff, then it's really important that you can step in and manage your own finances. And with a self-managed super fund, it's really important to try and pick up on that arrival of mental incapacity. It does happen to a lot of people, and the problem is that the person themselves, if they've got onset early dementia, they may get some paranoia as part of that. And what we have seen is where they've actually gone and they've destroyed all the documents, the history of the CGT of all the shares of their fund, just because they're afraid people were going to steal their money. And it's just something that happens with that cognitive decline. So it's just really important that, one, you try and keep on top of it, but two, you're also prepared. Everybody should have an enduring power of attorney in place so that somebody can step into their shoes financially. And every self-managed super fund, that power of attorney that the person has should specifically mention that it will allow somebody to step into their shoes to continue managing the super fund. When that does happen with a super fund, the actual member who's in cognitive decline must actually step down as a director, and the power of attorney is appointed in their own stead as a director in the fund. So it's not just a case of acting on the power of attorney, they have to be actually made a director in the fund itself. So just it's a lot of it's a hard subject to bring up. And it's a hard thing to talk to your partner about the fact that they may have some cognitive decline, but it's a much worse case to not be prepared for it.
Now, Liam, unfortunately, there have been a number of industry fund scandals in recent times. What are some of the lessons learned from that, I guess, particularly in relation to insurance?
Yeah, so one of them is if you've still got debt and you have insurance in your superannuation, even if you're not putting in contributions regularly, you may be semi-retired or retired, in order to keep the insurance going in most industry funds and retail funds, you must be at least putting in a contribution once every 16 months. So what a lot of my clients, what I get them to do is, if they've got a fund that just is holding their insurance and they've got a low balance in there, just put $10 or $50 in there by direct debit every 6 months, just to make sure that they trigger that it'll keep going for at least 16 months past that. So it's everything that the government has done to try and protect people who've got small balances. They have these knock-on side effects. And one of them is that the super funds are meant to cancel insurance if somebody hasn't put a contribution in after 16 months. Or if the balance is below 6,000, then they're meant to move the balance to the ATO. And that means that they'll lose their insurance as well. So just putting those contributions in every so often, small amounts, that will ensure that you keep that insurance in place for your family. And also make sure your family know where your super is. So keep a track record, keep the statement somewhere where somebody can find them, or specifically write a little note with everything, the bank, where your bank, who you bank with, who your financial advisor is, who the lawyer is, where your super is, who does your tax, everything like that. Just think in terms of what would somebody need to step into my shoes.
Just in terms of insurance, Liam, what sort of insurance should you consider if you're still working and perhaps in the later stages of your working life, approaching retirement, other than what is it, I guess, death, income insurance?
Well, it all comes down, Andrew, to what's your current financial circumstances.
Yep.
We're seeing more and more people now going into their 60s with debt. And in a lot of cases, they have their own mortgage, or they may have taken out more on a mortgage themselves to help their children, and they were hoping to continue working and pay that off before they eventually retire. But 72% of people don't get to choose the retirement date. So whether they get ill, partner gets ill, a parent gets ill, or they get retrenched. So if you're worried about the debt you've got, then you need to keep some life insurance in place, possibly some total and permanent disability. But if you're relying on your regular income to cover that debt, then you should certainly have some income protection cover in place. And all of those are available through superannuation at a reasonably low cost. It does get more expensive, so it's not something you set and forget. Every year you look and you go, okay, we've got the mortgage down to 150,000. We can reduce the life insurance down from 200 to 150, or maybe 165 to include a little buffer. But you've got to think in terms of what position do I want to leave my partner in or my family in if something happens to me. But as I said, because it gets more expensive as you get older, you need to be reducing it to actually meet your needs and not have all the bells and whistles and be paying for something you don't need. And that one last thing is, make sure, we've seen the problem with some of the industry funds, and it happens with retail funds. People do not put a binding nomination on their fund or a reversionary pension election. And that means that the fund then has to decide who the money gets paid to in the event of your debt. And they'll often have to write out to all your family and ask, does anybody have a claim on it? If you know you want to take care of your wife, or you know you want to take care of your oldest child, make a binding debt nomination on your fund. If you've got a pension in there and you wanted to go to your spouse, do a reversionary nomination that just ensures that it goes there. Do not leave it up to the trustees of that fund to make the decision, because they'll often take the easy option out and just, money ends up where you don't want it to end.
Now, Liam, as we look towards next year, of course, middle of next year is the introduction of this legislation where effectively those super balances that are over 3 million will be taxed at 15%. But what the government's tinkering with this bill, what's it doing?
Well, they still can't get it through.
Right.
Okay, so there's 4 days left, I think, or 3 days left of Senate dealings. So we think what they're doing, they've put it on notice that it's going to be discussed. But we think what they're doing now is they're going to try and wrap it up as part of a mega bill of all, and do a deal with the Greens and the Independents to try and ram it through as a last minute legislation before they close for the period. So, and my thought is bad legislation isn't any better by ramming it through. Discussion of the intricacies of these bills is really necessary so that people really understand that the side effects. And we've been talking about them nearly every time I come on your show. There are unintended consequences of this for a lot of people, and it's just bad legislation.
All right. Is there any sense that there may be some concessions there in the bill? I mean, for instance, just in terms of maybe linking it to CPI and so on?
Yeah, well, that's what we're afraid. If we believe that if it gets negotiated in the Senate properly, as an individual bill, then yes, maybe the amendments will get through to add the indexation or to stop taxing unrealized gains. But if they do it as part of a mega bill, that will just, all that discussion disappears, and they just give some sweeteners to the Greens and the Independents, and suddenly we see a bill passed that's bad legislation.